The statement came in the mail on a Thursday. I had not opened a paper statement in years. Everything I needed was online, and I had set most of them to paperless delivery a long time ago. But this one had arrived in an envelope, addressed to me from the brokerage firm where my retirement accounts were held. I almost threw it away without opening it. I assumed it was a notice about a policy change or a required disclosure that had to be sent on paper for regulatory reasons. I opened it instead. I read the first page, then I read it again, more slowly, because the number at the bottom of the page did not match what I expected. My account balance, as of the statement date, was a little under $31,000. It should have been almost $400,000. I logged into the online portal on my phone, standing in my kitchen, still holding the paper statement in my other hand. The portal showed the same number, 30,800 and change. I scrolled back through the transaction history. The losses had not happened all at once. They had been spread across about 18 months of trading activity, hundreds of transactions, in and out of positions I did not recognize, in volumes I had never authorized, options, trades, margin trades, holdings in single stocks that represented enormous percentages of the account. My financial advisor, the man I had trusted with my retirement savings for the better part of a decade, had been actively trading my account into the ground, and he had never said a word to me about any of it. His name was Steve. He had been my advisor since I was in my mid-30s. He had come recommended by my brother-in-law, who had been with him for years and had nothing but good things to say. I had met with Steve in person before I had moved my accounts over to him, and I had liked him. He had been patient with my questions. He had taken time to understand my situation. He had laid out a long-term plan that was conservative, diversified, and aligned with how I had told him I wanted to handle my money. For the first 7 or 8 years, the relationship had been exactly what I had wanted it to be. I had checked in with him once or twice a year. I had reviewed quarterly statements. The account had grown steadily, in line with the market, without surprises. I had recommended him to 2 friends and a cousin. Around year 9, things had started to change in his communication style. The annual reviews had become harder to schedule. He had been slower to respond to emails. When I had reached him, he had been friendly but rushed. He had told me he was building out a larger book of business and that things were busy. I had not pushed. I had assumed he was successful and that successful advisors were harder to get a hold of. The statements were still arriving on schedule. The account was still showing reasonable balances. There had been no reason to worry. I had stopped looking at the statements as carefully as I should have. The online portal showed a total account value at the top of every page, and I had gotten into the habit of glancing at that number and closing the app. I had not been reading the transaction details. I had not been looking at the holdings. I had been trusting the relationship. The reason the paper statement had arrived in the mail, I learned later, was that I had crossed a threshold. The brokerage's compliance system had flagged the account for unusual activity, and one of the automatic responses to that kind of flag was to send a paper statement to the account holder by mail to ensure that the information was received outside of any channel the advisor might have been controlling. The paper statement had not been Steve's choice. It had been the brokerage's, and it had been the first piece of information about my own account that I had received in a long time without Steve's filter on it. I called the brokerage's main line that same afternoon, not Steve's direct line, the main customer service number on the back of the statement. I told the representative, who answered, that I had concerns about activity in my account and that I needed to speak with someone in compliance. I was transferred twice. The third person I spoke with was a senior compliance officer. She listened to my description of what I was seeing on the statement. She asked me to verify a few pieces of identifying information. Then she put me on hold for almost 20 minutes. When she came back on the line, her tone had changed. She told me she could not discuss the details of any ongoing internal review with me, but she told me that she was going to immediately suspend all trading authority on my account, that no further transactions could be initiated by my advisor without my direct written authorization, and that she wanted me to come into the local branch office in person with identification as soon as I could get there. I went the next morning. I sat in a small conference room with the compliance officer and another woman from the firm's legal department. They had a folder in front of them that was at least an inch thick. They walked me through what had happened over the previous 18 months. Steve had been engaging in what they described as unsuitable and excessive trading across a number of his client accounts, including mine. The trades had generated significant commissions for him personally, which had been the financial motive. The trades had also been losing money for the clients because the strategies he had been using had been wrong for the kind of accounts he had been managing. Long-term retirement accounts that should have been in diversified, low-cost holdings, not in active short-term positions. I had not authorized any of the trades specifically. My agreement with the firm gave Steve discretionary authority, which meant he was allowed to make trades on my behalf without checking with me on each one. That authority was supposed to be exercised within the framework of the long-term plan we had agreed on. He had exercised it in a way that had nothing to do with that plan. The compliance officer told me that the firm had been aware of irregularities in Steve's book for some time, that an internal investigation had been ongoing, and that he was no longer with the firm as of 2 days earlier. The paper statement had been triggered by his removal, not by the activity itself. They told me that I had options. I could pursue arbitration through the industry's dispute resolution process. I could file a complaint with the regulatory authority that oversaw the firm. I could engage outside counsel if I wanted to pursue civil action separately. They told me that the firm itself had certain responsibilities for the conduct of its advisors and that they expected to make some form of restitution offer, but that the specifics would depend on the outcome of the formal process. I asked them how many other clients had been affected. They told me they could not share that information. The way they did not share it told me the number was large. I hired a lawyer who specialized in securities arbitration. She had handled cases like mine before. She told me, at our first meeting, that the recovery process was likely to be slow, but that the documentation was strong. The firm's own compliance review had established that Steve had violated his obligations. The trading records showed exactly what had happened, in exactly what volumes, on exactly what dates. The losses could be quantified precisely against what the account would have been worth if it had been managed according to the original plan. The arbitration took about 14 months. I attended hearings, gave depositions, and reviewed thousands of pages of records. The firm did not contest most of the core facts. They contested the size of the recovery and the calculation of damages, which was standard in cases like this. The final award was about $310,000. It did not fully restore what the account would have been worth if it had been properly managed for the entire 18-month period. But it covered the actual losses, the legal fees, and a portion of the lost opportunity. I rebuilt the account from there. Steve was barred from the industry. He could no longer hold a license to give financial advice anywhere in the country. I learned this through a notice that was eventually made public on the regulatory authority's website. The notice did not include the names of the clients he had harmed, but it included the findings: unauthorized trading, excessive commissions, breach of fiduciary duty. He was also facing civil claims from other clients. I do not know how many. I do not know how those claims were resolved. I never spoke to him again. The hardest part of the whole experience was not the money. The money I eventually got back, most of it. The hardest part was realizing how much I had not been paying attention. I had been an adult with a job and a family and responsibilities, and I had outsourced the management of my retirement savings to someone I had trusted, and I had assumed that the trust was enough. It was not enough. Trust without verification is just hope, and hope is not a financial plan. I do my own quarterly review now. Every 3 months, I open the statements, line by line, and I read them. I look at the transactions. I look at the holdings. I look at the fees. I do not need to understand every detail at the same level my advisor does, but I need to understand enough to know whether what is happening in the account matches what I have asked to happen. I have a new advisor now. He's fine. The account is recovering. The plan is back on track, but I will never again let a year go by without looking at my own money. The cost of that mistake was almost everything I had spent 20 years saving. I am one of the lucky ones because I caught it before it was too late. A lot of people do not. If this story hit you, subscribe. Every case on this channel starts with trust and ends with the truth.